Hey, everybody, welcome back. And can you believe it? Year over year, real estate is up in our area 7.5%. Now, some of you are like, how can that possibly be? Affordability is down, mortgage rates are up, inventory is down, there's still a massive demand. And when there is a limited supply and there's a greater demand, naturally, well, prices will find their equilibrium. Then, of course, some people are saying, hey, is this going to be a market crash? Is this going to be like what we experienced in 2007? Well, no. And some of you say, George, wait a second. You said 2007. It should be 2008. No, technically, it started in 2007 and was realized, or at least made more public, in 2008, 9, 10, and 11 as we started to come back out. So as we're taking a look at everything that is going on, we should not see anything like what we saw in 2007 through 2011 because our inventory is still very low, even though we've seen a small uptick in inventory, and primarily just because of this last week and whatnot, which is going to play a big role in things. But let's not do that. Let's go on. Let's take a look at what's out there. Plus, we're going to talk a little bit about what happened last week because I had some funny conversations, which is awesome. All right. So let's add, there we go. So when we take a look at this, we have Mason Vincent, who's the Associate Director at the Washington Center of Real Estate and Real Estate Research at the UW. He says earlier, because it says however here, earlier, he was talking about how interest rates have been bump up against the 7%, going a little over, bringing a little bit back down. And as they were rolling through, staying in the high sixes, low sevens, as you want to call it, we were still seeing quite a bit of activity, and affordability became a bigger issue, which then, however, so let's get to that. However, when they take a look at it, year over year, the inventory has continued to go up just a shade over 1%. Yeah, it's 1.32%. And we've seen a 7.5% year over year increase. And then on the right-hand side, you can see our new listings average of the last 7 days, 1,186 versus the pended, which are 1,270 homes. And then, of course, we had 878 closed sales. So you can see we are still, even though in April, and you're going to see those metrics down below, even in April or in March, we still saw a lot of homes coming on market, but more pended. And that has been happening since even before October. In fact, there was one person who published a comment saying, hey, is this real? And I said, dude, look at the metrics here. They're the same thing every single week. We are very consistent about single family. It's the predominant one. And we do talk about our local area only, not what's happening in other states, because it does not, that's not where we're at. Anyway, moving on. If we pop back, let me bring that back in again. If we pop back and then we come over here and we say, hey, listen, if you're really looking for super accurate information, look, subscribe, like the channel, please. It allows us to get out to more people. There's no marketing here. It's just super good information for you to make good decisions. Just like this, we have Freddie Mac. Freddie Mac is super important because, again, it's a running metric for us to look at. Even though they are, again, a 7-day running average, so they lag just a little bit, you can see that both in the week over week and the year over year, we're up just a little bit. In fact, year over year, we're up about 0.5%. And that's important because when you take a look at what we call acclimating to rate, that is exactly what people are doing. And it was anticipated. And if you go back to October, November, December, you'll hear us talk about people will acclimate. It's no different than you running, and you jump in the lake and you're like, what? And it's cold. But after a little bit, you're like, hey, this is not bad. Come on in. And that's what it's like. People are acclimating to rates. Why? Look, we're not going to see the 3s and the 4% rates. Those people with the golden handcuffs, they're going to need something around a 5.5% rate for them to consider selling their home and changing mortgage rates if they have a mortgage. And that's going to be just something that that's down the road, maybe 2025. It's not going to happen this year. I just don't see that in the cards. Anyway, moving on. But here we go. Let's talk about some headlines. Headlines, super important because it's going to give us a little bit of insight. More importantly, what's going to happen this coming Wednesday. First of all, it says persistent high rates have application volume stuck in neutral. Well, no kidding, because with higher rates, people tend to not make application as quickly. And as you can see on the close of business, even though we had some good reporting, we still hit the 7% again. Then in the bottom left-hand corner, what we have coming up this Wednesday is you have your core CPI. You have your year-over-year core CPI. I should say the first one's month-over-month core CPI, year-over-year core CPI, your FOMC, which is going to be giving you, again, a metric that the feds are going to be paying attention to. And, of course, the 10-year note, which is what we monitor as far as with mortgage rates. They don't control mortgage rates, but funny enough, they follow it very, very closely. So every time Yellen starts to send out more bonds and sells more treasuries, I should say, she has an impact on everything else because it has to do with debt, because most people don't know that's how the government finances are debt. And so they talk about people wanting a better return, so they have to have a higher interest rate, which is more cost to us as taxpayers. Anyway, I'm not going to get into that long dissertation other than they need to stop that in order to stifle inflation and overspending, which is what they're doing. Anyway, moving on. The bottom right. Hey, listen, guys. 5 questions to ask when getting quoted mortgage rates. Again, there's no marketing. Watch that video. The link will be down below. Watch that video. Why? Super important that you're asking the better question. I just had a couple of conversations on Thursday, and people had their eyes open about what marketing is on lenders' behalf, because they realized that, hey, to get the rate that they were talking about was $25,000 to get a rate by then. That did not make sense at all. So we talked about different options, and they went a different path, which was good. No, they are not my clients. We just had a really good conversation because they asked after watching the video. There you go. Now, let's have a little bit of fun from last week. Look at this. For those of you that were naysayers on what a buttload is, when I said that was a true measurement, some of you were like, oh, that's a bunch of horse pucky. And look at here. I wanted to say, no, it's not. Actually, it is true. And a buttload is a very large amount, a great deal, a buttload of money, right? That's what people are doing now to buy a house. They're spending a buttload of money. Now, here's the really funny thing about this. A buttload, according to the dictionary, as you can see, actually also talks about that the fact that it is an Americanism. Oh, that's super cool. From 1989, is that right? Yeah, 1985 to 1990. And you have butt to the power of 1 and butt to the power of 4. So depending on how big of a butt you're dealing with, and you have to have a load to it, that tells you might have a butt load or a bigger butt load by the power of 4. Just saying. Just kidding. But it is a real thing. For those of you that were making fun of me earlier, it is a real word. All right. Moving on. Let's talk a little bit about what's going on in the MLS. So you can see our chart's going up that way, which is a positive direction. What's super important about that? Let's dial into this one. Here you go. Remember, the one line is homes that are currently for sale. What is that price? And as you can see, 2023 was just a little bit higher as far as the average list price, which is for 2024 for the month of March was at $1,025,000. So a little bit less, 1.9%. But the important number is what is sold, and 11.3% higher. In other words, we were at 761,000 last year at the end of March and 847,000 this year. Okay. Well, for those of you that are out there, that is a pretty significant jump. 11.3% in price is a pretty consistent jump. When you look down below, and we look at year to date, 2 weeks ago was 799,000. 814,000 year to date. Now, some of you are saying, well, George, your numbers up above are higher. That was for the month of March, and it is consistent. So when we hit April April's numbers will be a little bit higher than what we're looking at now. The key is the trend that we're looking at, which is that sales trend that is heading up. Again, a lot of that is seasonally normal. So don't think that this is some crazy phenomenon, right? It's not. It's seasonally normal. And then it starts to taper down again. All right, moving on. So if we take a look at a deeper dive into our chart here, you're going to like this. So take a look at this. Technically, when we take a look at our numbers and you say, oh my gosh, we have 11.2% higher inventory. Well, that was 1,787 more homes that came on market year to date. Look at the month of, the same month, and you'll see that we have twice as many homes that came on market. In fact, more than twice as many homes just in the first 5 days of April. And that's what I was talking about. We had a massive influx of homes that came on this last 7 days. Crazy, crazy, crazy. But when you look at it on the other side, look, we're only 131 less homes pended and 527 homes sold that were less than where we were at year over year. That is a super important metric because what we're saying is we are pretty much getting a stabilized market back because now we're looking at 2 years that mirror each other. That means we have set aside the crazy 2020, 2021, and part of 2022 as far as, that's a lot of twos, as far as getting, our market back in and becoming situation normal. Because again, I think that when we look at our absorption rate, we look at homes coming on, we take a look at homes going off, and we take a look at the absorption rate or how much the market absorbs what is there. I think we're pretty close into balance. I don't think, people talk about supply and demand. That's not the case here. We have supply, or we will have what's called inventory and demand. And I think those two are very, very close together. Not necessarily supply, but inventory and demand, slightly different than supply. That is very much in balance, my humble opinion. All right. Let's move on. If we take a look at new construction is actually, as again last year, is doing quite well. However, super interesting when we take a look at these numbers here. Now, even though we're in, super low numbers for the most part as far as year over year, our sales are down 200 homes for the month of March. When you take a look at that, we're like 19 homes more than what we were, year over year for the same month of March. When we look at the year to date, right, and pended are only off 25 homes, 86 for solds, 117, are down, but we had 76 more homes. The super important part to look at there is the new construction is absolutely filling in a lot more. Normally, new construction should be about 11, 12% of our inventory, and it's basically a third. And so that's a big deal because we have new construction is infilling a demand that is there. And so we're also seeing a lot less incentives. I think that's why we're starting to see a little bit of softening of our pendants because buyers are now acclimating. They don't get these big credits. They're getting modest credits in some areas. Outlying areas, you're seeing a little bit more. There are some builders that were not offering commissions that are now offering commissions to buyers agents, because of the better quality of buyer that's been coming through. Not unexpected, but still good news. That'll be a different video. We're going to talk about the National Association of Realtors and the Sitzer class action lawsuit. What does that mean, Burnett and Sitzer, and what does that translate to you as a buyer or a seller? And we'll go into that on a follow-up video. Anyway, let's move on. Let's talk a little bit about REOs. Okay, for those of you looking at bank-owned homes and some of the REO officers and banks out there that are dealing with this, the great news is it's situation normal. Numbers are still amazingly low, which is super awesome. Okay, even year over year, our numbers, even though it says, hey, your active inventory is up, 22.2%. That's 12 houses, and over 3/4 of Washington State. That's peanuts. That's nothing, right? And so some folks are out there saying, George, are we going to see some crazy, foreclosure fall off and whatnot. And I'm like, you know, listen, we weren't allowed to foreclose. Not like I was doing it. Banks were not allowed to foreclose up until March of last year, end of March, because of the CARES Act. All right. So there were some notice of defaults went out, but there's a lot of avenues that borrowers have, including having, you know, since 2020, a 36% increase in equity. There's equity in properties, and the banks don't want to take properties back. And so there's some flexibility, and there's some loan programs out there specifically for them so that they can stay in their home. And that's a winner for everybody all the way around. They do a loan modification. If you need questions, let me know. If you're working with credit unions, which I think are the most amazing ones out there, you know what? They believe in taking care of their members and just be honest with them. Okay. And if you commit to a plan, make the plan, right? Because they're putting their head out there also for you. Anyway, with that being said, if you have any questions, please let me know. Feel free to leave any comments down below. And remember to smash that subscribe button. It's not raining today, so go out and have some fun. Come out to Bothell Mill Creek. See us out there at the open house. An absolutely stunning home. And we would love to see you. And, of course, you can mention us in the video. In the meantime, have an absolutely beautiful day. And I will talk to you later. Bye-bye.